it comes to investments, December is usually one of the most profitable months of the year, especially at the stock markets. And so, of course, everybody is eager to find out about the top themes emerging in 2010. Our researchers have collected 10 top investment ideas for 2010, and Giles Keating, Head of Global Research for Credit Suisse Private Banking and Asset Management and Chair of the Global Economics and Strategy Group, will explain these to us. Giles, before we zoom in on the top 10 investment ideas for 2010, can you briefly wrap up the year 2009?
Well, it began, of course, on a very bad note. People were still very worried about the crisis, thought that the recession would get deeper and deeper, and we had two and a bit very bad months. But after that, it was clear that some of the measures to tackle the crisis were taking effect. We got more and more evidence that the economy was improving, and really that underpinned a bull market across most assets. Very powerful bull market then in equities, in credits, beginning in commodities, and really perhaps the only darker spots, the dollar trended downwards, and also, of course, we did see the government bond markets selling off, although by no means a disaster there.
And what are your forecasts for 2010?
Well, we're essentially constructive across many markets, equities, to a lesser extent credits, and certainly we're positive for commodities in 2010. But I would say that in general we see it, if you like, a less easy year in the sense that we don't think the gains will be as big in most markets, much smaller, for example, in equities, much smaller in credits. And we do think there'll be some quite significant reversals along the way. So I think investors, although they can be strategically pretty bullish, I think they have to be prepared to take risk off the table from time to time when the markets get a bit ahead of themselves.
So let's get down to the top 10 investment ideas and begin with equity ideas.
Well, as a core holding, we think that investors should focus on quality large cap equities in America and in Europe, which have big exposure to emerging markets. Moving on from that, taking just a little bit more risk, we still think that emerging market direct investments into emerging market stock markets will do well. So that would be a second key idea. A third key idea would be to look at alternative energy. Now, this is obviously getting down to a narrower, more specific area, but we do think with the Copenhagen Climate Change Summit and with oil prices likely to be high, going higher, that alternative energy will be a good area to be investing in, and that's one of our mega trends, of course. And then finally in the equities area, we would be focusing on cyclical stocks, things which can include things like IT and some consumer discretionary stocks, as well as some small and medium cap stocks, which tend to do quite well at this stage of the cycle, and value stocks. And by the way, we, I'm afraid, don't really think banks as a sector are going to perform very well.
And what about the fixed income sector?
Well, in the fixed income sector, the message is focus on not the very highest quality credits, the AAAs, not the longer durations, but rather the next level of credits down, single A, double B, triple Bs, and really keeping maturities short and medium dated. We don't think there'll be big returns in fixed income, but we think the best guess is there'll be reasonable returns in that sector.
What are your forecasts on commodities?
Well, in commodities, we're certainly positive on the industrial metals, copper, for example, on oil, and indeed on platinum. We think all of those can see potentially really quite reasonable returns in 2010. Gold, with gold, we think gold quite likely that prices will go significantly further, but we think it could be a rather difficult market for investors in the sense that there's a risk that perhaps prices rise to an unsustainable level, and obviously if investors are able to take advantage of that rise, that will be good, but we think there could be a risk of really quite substantial reversals.
And what do you recommend for alternative assets?
Well, we're certainly positive on real estate. Our view is that one should begin really right now with investments in some of the emerging market cities where there's clearly a lot of upward pressure on prices already, and we think that can go further. And we would be building exposure to real estate in developed countries, where we think in a broader sense the longer cycle is now turning and has already turned in some locations. The other alternative assets area that we would focus on as obviously a part of people's broader portfolios is hedge funds, and there we think in terms of styles it will be directional and event driven which are likely to perform best.
And which currencies are likely to perform best?
Well, we remain bearish on the US dollar. We do think the trend there is still down. We don't think that'll be as clear a trend as it was in 2009. We think there can be some big gyrations, but we think the general direction will still be for the dollar to get weaker, at least for most of the year. We would also be looking to be using sterling as a funding currency, a currency that one would tend to go short, particularly, for example, against the Swiss franc. And then finally, because we think the overall situation in currency markets, as really in the other sectors, becomes a little bit more, shall we say, in different directions than it was before, we'd be looking to no longer take an unequivocal long position on commodity currencies like the Australian dollar against the US dollar, rather some more perhaps unusual currency pairs like Australian dollar long against the Kiwi.
So can you wrap up all these ideas?
Yes, I'd say 2010 looks likely to be a year where, with the economy still growing and interest rates still being kept low by the Fed and the ECB, but nevertheless moves towards taking away some of the extremely easy monetary policy that we have, we think that's an environment which is fundamentally healthy for key assets like equities, to a lesser extent credits, and definitely for commodities, but it's unlikely to see gains on the kind of scale that we saw in 2009, and it's likely to be a bumpier ride.
Thank you, Giles. We thank everyone out there following our monthly macroeconomic outlook and wish you good luck with your investment strategies for next year.